Okay, guys, welcome to episode 7 of Back to Basics, where we are teaching my beautiful fiancée Jessica how to trade. Again, if you're on either of our channel and you're just tuning in at this point, this is episode 7, so just go back and take a look, and there's a playlist on each channel, and it will go through in order. So last week we did support and resistance. This week we're going to do statistics. So again, if you guys don't know who I am and you're on Jessica's channel, I build a lot of the algorithms for Trade Ideas AI. I'm an auto trader or statistical trader by trade. So I love math and statistics and
I don't.
Not so much. So this is just a theory. There'll be no math equations. There'll be no x plus y over q or anything. I'm going to try to make this as realistic as possible, and I even got a whiteboard app in case we got to draw stuff out. So here are our socials you're seeing on the screen. If you're on my channel, go to the link underneath the video, and that will take you to Jessica's, and when she builds up to 100 subs, she'll be able to get the channel there. Twitters, Instagrams, all of that will be covered as well. So just follow us there, and we'll let you know when new videos are out, or I don't know, mostly pictures of our dog.
Yeah.
Really.
He's cute. To
be honest. Okay, so statistics. I'm excited, and you're mortified. So everything in life, and I guess you're probably even learning more about statistics with this whole COVID thing going on. Everyone's trying to give you their own angle based off different statistics, but in trading, these things are incredibly important, because I always talked about before how, the best traders in the world are right 60% of the time, and then it's all risk management, and anything that has an uncertain outcome benefits from looking at statistics. So the main purpose of this lesson will be just a basic introduction of normal distribution, standard deviation, why the market doesn't conform to those things, and what we can glean of it as traders. You look scared.
Yeah, well.
So first thing is the law of large numbers, right? So there's a saying that Tasty Trade, they always say, trade small, trade often. And this is because we're always going to try to get to some statistical outcome with our trading, right? It's, I talked about support and resistance. We're going to go into trends and all of this. We're not done the technical side of things, but this is an important break to show you why technicals work. And the first thing is the law of large numbers. So a lot of people, they'll look at a chart and, I'll say something like, look, this hammer candle has a statistical edge of going higher. And then they'll see the hammer and the stock tanks, and they're like, okay, well, technical analysis is bullshit.
Yeah.
Right? But that's not what we're looking at. We're looking at the law of large numbers. And one of the best quotes that I hear is, flip a coin 3 times and tell me what the probability of reaching heads is. Right? If you think about it, if you flip a coin 3 times, you can either hit heads once, heads twice,
right,
or heads 3 times.
Right.
None of which are 50-50.
Okay.
But we know if you flip a coin, the odds are 50-50.
Right.
So what's happening is you have too small of a sample size, if you're just looking at 3, to get what we know the outcome is.
Bear with us, folks. This could be a long one.
But, right, so if I flip a coin, and this is what this next slide is here. So, bunch of squiggly lines. But essentially what this chart is somebody flipping a coin a certain number of times, and each line is a different trial. So they flipped a coin a total of 1,000 times, 1,000 times, 3 times, right? So the black line is them flipping a coin 1,000 times. The green line and the red and the blue, so 4 times, is the same, right? So you can see that between the first 1 flip and 100 flips, what the actual result was way different than 50-50.
Okay.
Right? You having problems reading this? I can go over. This is important.
You didn't tell me reading would be involved.
Ooh.
Oh.
There we go. Focus up. So, all right, let's follow this black line. I'm following the black line on the screen. Okay, so each of the colored lines, actually, let's ignore all the lines except the black one.
Okay.
Right? That's one study. So think of what's happening is the guy flips the coin and he writes down whether it's head or tails. And then he flips it again and he writes down whether it's head or tails. And the whole time he's doing this, he's adding up every time he flips a coin and then trying to figure out what the probability of flipping a coin is.
Okay.
Right? So what happened was he added, the first time it was 100% chance of heads, for example, because he only had one flip and it was head.
Right.
So the next time he flipped it, it was also heads. It still says a 100% chance of heads. And then the next time he flips it, it's tails. Now he's saying it's a 66% chance that it's heads because you have 2 heads, 1 tail.
Okay.
As you go on, a lot of people say, okay, if you flip a coin 10 times, you probably will get a good estimation of what the probability of getting heads is. Well, what turns out is 10 is just right here. So at 10, he was still saying it was a 60% chance of getting heads. Mm-hmm. And then you can see that later on, when he's at his about 200th coin flip, the poor bastard who's flipping the coin this much, he's saying it's actually like a 45% chance that it's heads.
Okay.
So he had to flip a coin 1,000 times before he got that it was a 50-50.
Right.
Which we know what the probability is, right? There's very few things in life that you know exactly what the probability is.
Right. Okay.
Right? So this we had a goal to get to. But this is why you see a lot of crap in the media and stuff, and why you always hear me kind of harp about whenever you give me a study, I always say, how'd they do it? Where is it from? All of this. Because if I flipped a coin...
When I give you a study,
well,
when anything comes out of my mouth, people, I need to have it fact-checked. Just putting that out there.
That's what I do. But you could see how I could flip a coin 3 times, and I could hand you a piece of paper and say there's a 66% chance that if you flip a coin, it hits heads.
Okay.
And how my study has shown that, and I was honest about my study, but it's wrong. Because the number's too small, right? There's no way it's a 60% chance to get heads, right? So what you would do is you would look at that study and say there's no way that's valid. You'd hand it back to the person.
Okay.
Right? So then each of these lines are a different time that somebody flipped that coin.
Okay, right. So the blue one, they got tails.
First.
Got it.
Right.
Okay, yeah.
Right? So, and this is just to show, and this is just called, in mathematics, it's called the law of large numbers. Right? If I want to find, we can just use another example. If I wanted to find the average height of a man, and I walk up and I talk to 2 dudes who are twins and 6'6", and I say, well, average height of the guy is 6'6". It's incorrect. Not because I was dishonest, but because my sample size was not large enough, right?
Got it.
Even going further, if I went to Sweden and I took all the heights of the guys there, and I just said that's good for the entire world. We know there's some these guys are Vikings, and there's some people who are way shorter, and it was, even if I did 1 million men in Sweden, it's still not a good statistical sample.
Okay.
Right? Just not representative of the world. So the reason that this is important is because you have to understand that even if you develop a great trading strategy that has a 70% accuracy, which is just better than like everyone else on planet Earth, then 3 out of 10 times you're going to lose. So if you build the strategy and you're like, it's great, I've got a 75% win rate or a 70% win rate, and then I trade 5 times and I lose 3 times and I make profit 1, and then break even, then you're like, oh, my strategy sucks. And you would be shocked how common that is amongst traders. They'll come up with a trading strategy, they'll do it 2 or 3 times, it will lose money, and they'll say, I'm out of here. But, we know that even something 90% accurate can have massive runs of being incorrect.
Right.
Just probabilities, right? Statistics. Okay. So now's where things get a little bit more detailed. So think of each of these bars is like the line in the last graph, right? Each of these bars is an individual study of 1,000 coin flips.
Okay.
Right? So each bar is a different time a guy flipped a coin 1,000 times. You can see that in most cases, that was enough data to get an average here of 50, right? It says 500, but this is for something different. But anyway, it's the average is 50%, but you can see that sometimes, but very rarely, the guy flipped the coin a lot, and he's showing a 54% heads even after 1,000 flips.
Okay.
And that's what, this guy over here found.
Right.
And this guy over here found the opposite. But generally speaking, you get this bell curve. And I'm sure you've heard about the bell curve when you're like marking tests, right? But basically what this is doing is it's showing, because you can never find, you could flip a coin theoretically 1 billion times. And in theory, not get an exact 50-50 win rate. It could be, 51 or 49 or whatever. So this is how we represent statistics, where we say if something is normally distributed, which means essentially perfectly random, they will develop curves like this. And what we say is that the peak of this curve right here is probably the correct answer. We'll never know 100% sure, and this gets into all kinds of crazy esoteric nonsense. But we can tell by this graph that we are fairly certain that the probability of flipping a coin and hitting heads is 50%. But in some point, we get these tails in which things don't kind of go as planned, right? Again, you could have a strategy that's 90% correct and still have a run of 100 trades that lose. The odds of it happening are very small, so they would be in what we call the tails of the distribution, right? And there's also a chance that if you have a 90% strategy that you're right 100% of the time for like 5 years.
Yep.
Right? So again, these are happening in the tails.
I getcha.
So everything we've talked about so far is pure randomness.
Okay.
Right? These are all random trials, which is why you can use a coin flip or a dice roll or any game that we understand what the probability is, but we know that it's sheer and under randomness. Now we have our normal distribution, right? And our normal distribution is essentially this bell curve that says this area in the middle at the very height of the curve is probably our expected result from whatever game we're playing. And then anything that happens outside we call standard deviations. So that's in the next one. And again, this
bring me back to grade 12 right here.
This will all, and you at home too that are losing it, this all comes down to one point that is insanely powerful and kind of shows how you can make money trading. So there's a huge end takeaway from this, I promise. It's I needed to teach you everything up until this point to then explain to you how you can make money trading.
Okay.
Right? So you at home, have a little faith. I know she's probably looking at the clock that's ticking how long we've been live here and wondering what else she can do. But so again, you've got a strategy that is, and now we're going to go and we're going to translate this and say, okay, this is stock return data. If stock returns were random, there's a whole bunch of people out there, it's called efficient market hypothesis, that think that a stock return is random, that there's no way you can ever predict the market.
Okay.
Right? There's a massive, if you went to university, like I went to university to study stocks, they say there's technical analysis doesn't work. You can never make money. It's impossible to beat the market, which we know empirically is wrong, but it's what's taught. So what you would expect to see if stocks were random is this same normal distribution, right? And the lines I have here on the bottom show that in what we call a standard deviation, which is how far away you are from that center point of value. One standard deviation, 68% of all of your occurrences should happen in that one standard deviation away from the mid. So for example, flipping a coin, we know the mid is going to be 50%. We're basically saying that about 70% of every trial we ever do in our lives should be fairly close, or one standard deviation away from 50%. Okay. 2 standard deviations is 95, 3 standard deviations is 99. Everything that's random, pretty much, follows this exact curve if studied enough.
Okay.
Right? What we notice in actual trading, and this is the crux of it all, is we've studied, we scientists, smarter people than me, have studied trading, they've studied markets, they've studied price movements, they find out they are not normally distributed. They do not follow this same normal distribution model that random type things do. They have what we call fat tails. So the difference between this thin line, which is a normal distribution, and the thick line, which is a fat tail distribution, means that although often price is random, there's some randomness that pops around, there is more of a directional movement one way or the other in stocks than statistically should exist. So if trading was random,
Okay.
right, it would follow that curve.
Right.
But it's not, because these, so what this means is that if it's random, you wouldn't get these runs in stocks that you do. They exist on this fat tail of the curve, and that's where we're going to go into. So again, the whole reason that I did this is that there's certain kinds of traders that every time they see something go up, they want to short it and have it come down. And every time it goes down, they want to buy it and have it go up, because they think every price movement from day to day is random.
Okay.
Right? So if it's gone kind of up one day, it should revert back down others.
Got it.
Right? And however, there are people that trade that way, and there is ways to trade that way, and it's very successful. But the fact that we have these fat tails mean that there are trends that exist in the market. So the bulk of the money that can be made out there is by hunting in that fat tail. So what that would look like for a chart is a stock that's trending up and is continuing to trend up in a non-random way, right? So what we assume causes these non-normal distributions is essentially, a stock moves higher, and then you get crowd psychology on top of it. So I've talked about how everything I do is related to psychology before, and this is kind of like my mathematical proof about why I do it. Right? 'Cause if things were random, they'd be normal. They're not normal, therefore not random. Therefore, there's edge for us out there, and it kind of proves that it's in the whole crowd psychology of pushing the market.
Okay.
Was it worth it?
Was what worth it?
All this, was it worth it? I've shown you the secret of trading. It's just right there. But essentially, what the reason behind this, and the reason I show you this, is because we're going to teach you trend following methods, which basically means that you are going to find a trend that's already established. If the stock is moving higher, you're going to look for a place to enter, assuming that trends continue. And again, we know trends continue because the market is not normally distributed.
Okay. Gotcha.
All right. So I think I probably put everyone to sleep there, but this is very, very important. So the next lesson, we're going to go into trends, which I promised last week, but we'll be doing next lesson. And the reason we're doing that is now that we know that trend following systems have a statistical advantage over the market. So the people at home, if there's one way to take away from this, if you're one of those guys who's trying to pick the top of the market because you think everything reverts, and pick the bottom, and your strategy is not doing well with it, take a look at the data, right? You can go research it yourself. It's all there. That trends persist way longer than they should statistically because of psychology, and therefore there's money to be made following trends.
There you have it.
And if there's any questions, our links are in the description below. Just put something here that has all of our socials and everything. Go, if you're on my channel, go give her a sub, and vice versa. Same with Twitter. That's pretty much all I use, to be honest. If you're interested, we're going to get her very soon on the Trade Ideas Simulator. There'll be a link and a discount code below as well. Full disclosure, it's an affiliate link, so it helps the channels, and it's kind of the reason that we do all this. So